In this show, I'm gonna help you understand everything you need. What the just happened? Anyway, I'm gonna help you understand everything about inflation, CPI, PPI, FOMC, who is Jerome Powell, why interest rate cuts are important, and how this all relates to crypto. There's a billion ways to make money in crypto, and I'm on a mission to find them all. My name is Fefe, and if I find anything, I share it with you. So if I make money, you can make money too. If that sounds good, subscribe to the channel. We don't just have pre-recorded videos, but we have a bunch of live shows, giveaways, trading, alpha, and much more. Let's jump into the video. Now, before I deep dive into all the modern stuff like inflation and CPI and Jerome Powell, let me take you back to the very beginning. Back in the days, if you wanted to get something, you had to barter. That means if you had a goat, you could swap it for a piece of wood. But that wasn't sufficient, so a random dude discovered gold. Now, gold is this precious metal that is very limited in supply, and therefore people believe it has any value. And so they transitioned from bartering to measuring everything's value in gold. The problem with gold is that it's not divisible, so you can't really break it apart. It's very heavy and difficult to transport and store. So they came up with the concept of money. They were a custodian that said, hey, give me your 1 ounce of gold and I'll give you an IOU. You can go and interact with that IOU that is easy to carry, easy to divide. And if you ever want to exchange your IOU for gold, you can just come back to me and I'll give you the gold. And through years and years and years, the banking system has been created. Now, when I say banking, you probably just think about a building where you go and take money from or put money in your account. That tells you can't withdraw, it will be expensive and whatnot. But banking is much more than that. That includes banks, financial institutions, credit unions, savings and loan associations, investment banks, and much more. Now, all of these institutions operate based on something called the fractional reserve banking. Now, I don't know if you know this, but hold on to your chair. Fractional reserve banking allows the institutions that you deposit your own money to lend a huge portion, we're talking 80-90% of it, to a third party without you ever knowing. Now, that results in debt, right? Because if someone borrows, they have to pay it back. And all this, what I just explained, circled into a debt-driven economy. Now, there is $34,705,839,365,700 worth of debt in the United States alone. Meanwhile, there is only $2.5 trillion in circulation. Do you see the problem? Now, of course, if people borrow, they get into debt, but it's not free to borrow, and therefore they get into more debt. There is a fee that you have to pay to borrow money, and that is what we call the interest rate. That is a percent that you have to pay on the borrowed amount every single year. If the interest rate is 5% and you borrowed $100, you will need to pay $5 as a fee every year on top of the installment of the $100 that you're paying back. Now, you remember I was telling you about gold and how you had one IOU for 1 ounce of gold? Well, here's the thing. In 1971, Nixon decided to separate the two and get off of the gold standard, which was basically the birth of fiat currencies. And that meant that they can print money out of thin air. While we had gold, which was a limited supply asset, now we have printers and people who print money. Anyway, it's not only people who borrow money, but also governments. And when governments borrow money, they need to print more money. And printing is basically a click of a button. And by printing more money, the value of your money is diluting because there is more money in circulation. And because the value is diluting, people need to increase their prices, and therefore we have higher prices, and that's what we call inflation. Inflation basically means that there are higher prices for goods and services, and therefore the purchasing power is falling. Then there is CPI, Customer Price Index. You probably have heard this a million times this week. Now, CPI is an economic indicator that measures the average change in prices paid by customers for a bucket of goods that are selected and in this bucket. This is the number that is primarily used to track inflation. CPI is measured on month-to-month basis, which means is this bucket of goods are more expensive than it was last month, and on a year-to-year basis, which means last year, this time, did we pay more for these products or less? And then you have PPI, which is Producer Price Index. Another thing you probably heard a million times this week. PPI is similar than CPI. The only difference is that it measures inflation on the production level. Rather than reflecting on the changes in certain goods prices, it reflects on the changes in production cost and raw materials. So last year, this time, was it more expensive to produce a t-shirt than it is today? If so, how much? And that's PPI reading. Now, all of this information and much more is passed on to the ultimate boss, not this one, but This one. This is Jerome Powell, the head of the Federal Reserve. The Federal Reserve is the central bank of the United States, the top. They regulate the banking system, ensure stability, and protect consumers. The Fed basically guides the banks and helps drive the economy. But that's not all they do. They're also the ones determining the interest rates. Do you remember I talked about interest rates? The percent that you have to pay on every dollar that you borrow? Well, these guys tell you how much you have to pay. I know. Crazy. By taking everything under consideration, these guys come up with the interest rate that is suitable for the economic situation. And let's boil this down. This is where everything connects, okay? Bear with me here. This is important. If you have high inflation, meaning high CPI and PPI and other economic indicators, that means that the inflation is too high and needs to be tamed. The way to tame or reduce inflation is to increase the interest rates on borrowing. Why, you ask? It's simple. When the interest rates are high, that means you have to pay much more to borrow money. Therefore, less people borrow money and less people invest or spend. Less spending leads to reduced prices because of reduced demand, and therefore inflation is tamed. Now, the other way is the exact same thing. If inflation is low, meaning there is not enough activity in the markets, for example, COVID hits and people are not buying, not spending, they will need to stimulate the economy and inject money. Therefore, they cut rates, meaning they reduce the interest which is required to borrow money. Therefore, because you will have to pay very little to borrow any money, everybody will borrow and start spending and therefore increase the activity in the market and therefore increase inflation. Now, all this is not decided by Jerome Powell by himself, but by a committee called the FOMC, or the Federal Open Market Committee. The FOMC has two main goals. Number one, maximize employment, and number two, keep inflation at 2%. The members of the committee meet time to time and discuss the economic projections and discuss the inflation numbers that they received. From all those data, they make a qualified decision whether they have to increase interest rate, leave interest rate unchanged, or reduce interest rates. The FOMC meets 8 times a year, which is about one meeting every 6 weeks. Now, I don't have time to cover everything in detail, but in these meetings, they don't just discuss interest rates. They talk about a lot of stuff: quantitative easing, quantitative tightening, open market operations, and much more. There's one more thing called the dot plot that you might have heard this year, but might not understand. Every quarterly meeting, the Fed releases something called a summary of economic projections. These reports are very, very important because they give insights into the thinking of the FOMC. Now, one tool they use within these reports is called the dot plot. The dot plot provides a visual representation of where members believe the economy is headed and what the interest rate changes should be in the next years. Each dot on the plot represents a projection of one of the FOMC members. The reason why these are important because, for example, in this week's FOMC, we saw that 4 members voted for 0 cuts this year, 7 members voted for 1 rate cut this year, and 8 members voted for 2 rate cuts this year. That means, and from this data, we can see that there is a very, very high chance that we're gonna get at least 1 rate cut this year. And remember, what does rate cut mean? Rate cuts mean that people will invest more into the economy. Now, you understand everything. You're an expert on FOMC, monetary policy, US banking, gold, and whatnot. But let me give you my thoughts on what to look for in the next CPI readings and next FOMCs. For a bullish scenario, we have to see the following. We have to see inflation cooling off, meaning there is lower inflation. There is a website called Trueflation. If you look at it, they list the inflation day by day. Everything is on the blockchain, by the way. So they update these inflation numbers every single day on a yearly basis. So that means that there is 2.2% inflation from a year ago on this day. They use thousands of data points, so this could be interesting to look at, but you want to see this go closer to 2%. What is interesting here is that the US government reported rate is 3.3%, so Trueflation measures it on a more detailed basis. So obviously, while it's 2.2% here, the government relies on the 3.3% official data that they have. This is something to keep an eye on, but this is a platform that you can use. Now, why do we need reduced inflation? Because inflation is lower. That means that prices are in control, the Federal Reserve is in control, and they can start reducing the interest rate. And by reducing the interest rate, people will borrow more, invest more, and the economy will boom again. And if inflation is reduced, there could be a rate cut by the Federal Reserve. Now, very important to note here is that a lot of people say, yeah, but last time when we saw a cut, we saw a massive crash in the market. Yes, and there is a difference. When there is economic uncertainty, for example, in the case case of COVID, when the rate cuts happen because they see that there won't be any activity, it could be devastating. It's basically just oil on the fire. But when there is a very heated inflation, meaning a very booming economy, when they increase interest rates to tame inflation and then cut back because they achieved their goal, that's a two completely different story. So a cut in this scenario will most likely result in higher prices in crypto as well. And what is the bearish scenario? Well, bearish scenario would obviously be rate hikes. That means the Fed didn't achieve its goal and the inflation is still way above 2% as their goal. That means they still need to increase the interest rate to make it even harder for people to borrow. Now that would make dollar and bonds much more attractive investments, obviously much safer as well than, for example, crypto and other risk assets. So that would have a devastating impact on crypto. Another tool Now there's another cool tool that you can use to see whether there is a projected interest rate hike or interest rate cut, and it's called the CME FedWatch tool. Now if you search for CME FedWatch tool, it will come up. You can scroll down here, you will be able to see the current interest rate, but if you go down to probabilities, you will see a complete expert calculation whether there will be rate cuts in these months. So for example, on a September meeting, there is a 61% probability for a cut rate. Oh, that is it. I know that it was heavy. I know that it was long, but it was necessary. So now if you watch through, I salute you. You're an absolute legend. Now you understand how the whole thing works and you are not the one being a sheep at a dinner table. All that said, thank you so much for watching, guys. Don't forget to subscribe to the channel right now. Follow me on X if you like this content. There is a link in the description. And if you are there, you can check out my trading channel as well, because I'm not only a smart dude when it comes to this content, but I'm also a trader. And I have a live show covering live news, live trades, and much more on the other channel, which is called the 100X Club. We're all banter fam. Go and check out the link down in the description. It's called Fefe's trading channel, the 100X Club. I hope I will see you there. Other than that, guys, thank you so much for watching. I truly appreciate you, and I believe I will see you in the next one.